Well, hello, everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I am delighted to be with you today. We are talking about a strategy that at first I poo-pooed and is now near and dear to my heart. It is called a buy right covered call. And, like I like to say, this is not your mama's covered call. It's a different kind of beast. And that's what we're going to spend the entire class talking about. I've got some announcements for you coming at the end of the class. You're going to want to make sure you stick around for those. If you are not following me on X, here is your formal invitation to do so. My handle is at Barb Armstrong CS, and I am posting content there on a daily basis that I think you'll find informative and helpful. One of the things I will be posting today is the new schedule for 2025. I'm going to go over that at the end of this class. I'm going to be teaching Getting Started with Options, and this is the series that I created back, I don't know, 7 years ago. It's the class I would have liked to attend, and I'm going to be passing the baton over to Cameron May. We're going to be doing, there used to be a show called Trading Places, and Cameron and I are going to be trading places. He's going to take over Getting Started with Options, and I am going to be taking over Getting Started with Technical Analysis come January. So Cameron and I are going to be doing that switch. I've got Cameron actually with me in the chat today. He's a friend and fellow coach, and he understands. He's the one that actually turned me on to this strategy, because I thought this was the dumbest thing I'd ever heard of. And I said to Cameron, why would someone trade this strategy? And when he explained it, the light went on. So, if the light hasn't gone on for you yet, hopefully by the end of the day, it will be there. You'll want to follow Cameron on X as well, his handle, Cameron May CS. Okay, let's get through our important information so we can get right down to business. Options carry a high level of risk and aren't suitable for all investors. You have to also meet certain requirements in order to trade options through Schwab. So I mention that because you have to apply for option trading privileges, and I'd hate for you to practice this strategy or another option trading strategy and go, okay, I've been trading this in my paper money account for months. I'm finally ready to place my first live trade, and then it won't go through because you don't have approval to trade options. So just know that you've got to apply for that. We use the paper money application on the Thinkorswim desktop platform, and it looks like, smells like, feels like real money, but it's not. Okay, and know that this buy right covered call, we're selling a call, and know that one of the nuances or differences is that in paper money, a covered call will never be called out early, but that can happen in a live account. And we'll talk about, how a trader might feel about that. And we're going to be looking primarily at the charts today, which is technical analysis. But Schwab doesn't recommend that that's your only means of analysis before you make a trading decision, of course, right? Right. Okay. So, I've talked about paper money. We're going to put a stop loss order in with our example trade today, but know that stop loss orders aren't a guarantee. Sometimes if something gaps to the downside, as Oracle did this morning, ORCL, post earnings, you may have, if you had a stop on that, you may have ended up out at a lower price than you were expecting, which can lead to a bit of sorrow, right? Right. Okay. So what's on the menu today? We're going to discuss what a buy right covered call is. We're going to identify, and we're going to talk about when you might want to place this trade, why some investors might consider this or traders might consider this to be an interesting strategy. We're going to do an example trade, and then we're going to discuss how you'd manage that. And actually, I have a trade on in one of the accounts, and we're going to look at that and do a little bit of trade management as well. If you are brand new to this, please feel free to type a greeting into the chat, because we link arms here every Tuesday at high noon, and we are figuring this stuff out together. If you don't know anything about options, you're in exactly the right place. So feel free to type a greeting into the chat and we'll say hello. I'm always grateful for, so many of you who are here, sometimes 15, 20 minutes early and kibitzing back and forth with each other. So to Jose and Lisa and Jack and Naresh and Common Sense 101, I love some of these handles, and Mike and Austin and Bob and David. Thank you all for being here and for being so participatory. What is a buy right covered call? Well, this is a strategy where a trader both buys a stock and at the same time sells a covered call. And this is where I said to Cameron, that makes no sense, because if a stock has been uptrending and I say, okay, well, I'm going to buy this stock, why on earth would I want to sell a covered call? That seems counterintuitive. And he said, well, maybe you'd like to earn some income. Maybe you don't want to do a long-term trade. And so maybe you'd like to sell a covered call in the middle of the road. So here, if we think that the stock is going to continue to go up, like Kamsa, and we say, you know what, I'm going to sell a call right here. And if I get called out, Bob's your uncle, I'm totally cool with that. Let's say the stock is trading at 50 and I sell the 54 call. So say I'm selling this 54 call, and let's say I get $2 for it. Now I'm just making these numbers up. I have no idea if that's what we get, but we're going to go through some live examples. So if it's trading at 50, if I'm called out and it goes up to 54 and I got paid $2 for the call, how much can I possibly make? Well, the most I can make is the $4 in stock appreciation plus the $2. So the most I could make is $6 per share, or $600. Okay. So I could possibly make $6 a share or $600. How much could I lose? Well, technically speaking, if the stock went to zero, I could lose the $50 a share I paid minus the $2 that I got paid for the call. So my potential loss is 48. Now, realistically speaking, what are the odds of something going to zero? Well, maybe not high, but maybe what you'd say is, well, I see support here at 48. I'm going to put a stop loss order here at 46. So if I paid 48 to get in, my stop loss is at 46. How much could I lose? Well, if I get out in the neighborhood of 46, and again, there's no guarantee, I could lose 2 or 200. And how much could I make? Well, I could make up to 600. And so this is a strategy. Now, not everybody uses a buy right covered call this way, but it's this idea of, I'm going to buy the stock, I'm going to sell a call. And some people do this and they think, well, earnings is coming, it might protect me if, it might provide a level of protection. Now we're going to look at an example where, a stock did pull back and it helped alleviate some of the pain. It didn't eradicate all of the loss. But we're creating an obligation to sell at this strike. And so if under no circumstances would you want to sell this at 54, then don't sell a covered call. It's kind of that simple. Okay. And what's the difference between this and a covered call? Well, with a covered call, you typically already own at least 100 shares of stock, and then you're adding the cover on it. You're selling the covered call on top of it. This one, you're doing both at the same time in one fell swoop. You're both buying the stock and you're selling the covered call. And although there, are multiple different ways one might trade a buy right covered call, the one I'm going to talk about today is this idea of it's an uptrending stock and we would like to sell this call with the intention of being called out. Now, how else might you use a buy right covered call? Well, let's say you have something that's been going sideways for quite a while. So it's been going like this. And you might say, I really like this company, and I think that at some point this is going to break out. But if it goes sideways for 6 or 8 months, how about I could buy the stock, sell a covered call here, buy it back when it gets here. So, and if in fact this pattern continues, then when it comes back up, I sell another one, and then I buy it back when it comes back down. But maybe earnings is coming up and you're thinking, hey, if this breaks through and goes to the moon, if my covered call is here, I'm called out, but I've made some money along the way, and I'm okay with that because what I'm looking to do is generate some income or maybe grow the account. This is more of a dating strategy. It's not a marriage. Okay. So if somebody is asking the question, if you are called out, do you keep the stock and sell more covered calls later on? No. If you are called out, it means when I sell a call, what does it mean? When I sell a call, and I will put a link into the very first class in the series where we go over the basics of what does it mean to buy a call or sell a call. When I sell a call, what that is saying is I am okay, I am creating an obligation to sell the stock at the strike at any time between now and expiration. So if I'm called out, it means by definition that I have sold now the stock. Okay. And we're going to go out and we're going to look at an example in just a minute. And I think that'll provide some clarification for you. Okay. But now if we're called out, could we do a wash, rinse, repeat and buy shares again and then sell another covered call? Absolutely. If we see a setup that makes sense to us, we could certainly do that. And so, but we have to be aware that early assignment can happen at any time. What does that mean? It means it may not, have I seen this happen in my live account? Yes, I have. And you know what I was doing? The happy dance, because I had bought this with the intention of being called out. And when I got called out, it meant, before expiration, it meant that I got my max gain faster. The money got deposited back to my account, and then I was able to place another trade. But it can happen at any time. And that means that I now no longer own the stock. Okay. And upcoming events like a dividend or earnings can increase the risk of being called out early. And so we just need to be aware of that. And, so when do we want to place this trade? Well, some would say when volatility is higher, premiums are higher, so we get more for this covered call. So that might be a time when volatility is higher. Now, right now, volatility is lower. Does that mean this strategy is dead to us? Not necessarily, because even though volatility in the marketplace is lower, some individual stocks still carry a higher degree of volatility. And then we've got to be aware that if we sell the stock, this can be a taxable event, right? And for that, I don't give tax advice, but I'd suggest you call your accountant. And if you don't have one and you do a lot of trading, you may want to consider, bringing one into the fold. So what are we looking for? Well, it depends on how we want to trade this, right? So if we look at this and we say, well, we want to do that kind of sideways thing, we could look for a stock that's moving in a sideways trend, or we could be looking, if we want to do this strategy I'm talking about, and we are going to, this week, I have a number of example trading plans. The buy right covered call, one example trading plan will be added to the fold this week. So we're going to look for a stock that's been uptrending. And we are going to look for, and I used to create, like nerd alert here, I used to have a checklist for every type of strategy I traded. And I also wanted that sector to be uptrending. And then I also would look and say, like, hey, is the market uptrending? So, we might be looking at all of these things, right? So we might be looking for that. And some, like if we're looking for this sideways, we might say, hey, we want to look for something that's approaching a ceiling because then we'll get more for this covered call. Okay, and we're looking for it when it's rolling back under. Now, if we're doing this as a bullish trade, so these are really two different trading strategies using the same tool, right? Like it's kind of like having a hammer. You can use a hammer to hang a picture. You can use a hammer to frame a house for habitat. You can use a hammer to break a window. Like you can use a hammer for a lot of different things. I wouldn't suggest the breaking of the window, but it's just a tool. And another way we can use this tool is for a bullish entry. And this is a bull flag where we're looking for a close above the high of the low day. But there are any number of bullish entries that could be used if we're using a different using this tool in a different way. But regardless, we were looking for stocks that have higher trading volumes, and some might say, well, how do you define that? Well, in our example trading plan, we usually say, we want it to be 1 million shares a day or more. And then we want options that have high trading volumes. And why do we care about that? Well, because if we've sold something to open the trade, when we go to buy it back, we want there to be somebody who might be interested in buying it back. And when we have higher trading volumes, that gives us what we call liquidity. There's a market. And so we might say, well, I want at least 20 times the number of contracts that I'm interested in trading. And then others might say, you know what? I don't even look at this. It's not part of my trading plan. And this is just an example. You can make your trading plan whatever you want. You might say, I want just as long as the bid-ask spread is less than 10%, ideally pennies apart, I'm going to assume that this number's okay. Or you could have that as another item on your checklist, right? And you're looking to put checks beside all of these. All right. And those trading plans, by the way, they live in the trade management mini session bucket webcast playlist. And they're fairly short. Like they're all, these ones, the example trading plans tend to be a little longer, but they're all under 20 minutes. Okay, so let's go out and look at something in the market. And remember our checklist, well, is the market uptrending? Well, it hit, this is the S&P 500, hit a new all-time high 3 days. Well, it was actually Thursday of last week. Up 20, almost 27% year to date. So pretty hard to characterize that as anything other than bullish. Okay, we're going to look at American Express. That's going to be our example. And when we look at American Express, well, it's up 62.5% year to date. And, it's continued to uptrend. It was kind of consolidating. And today, we have it moving to the upside again. So is the stock bullish? Check. Is the industry group it's in? So here's the financial sector. Has that been strong? Well, it's up 30% year to date. So it's outperforming the S&P 500. And it's just kind of pulled back for the last week or so and appears to be, bouncing today. So check, market check, sector check, stock check. Okay. Now with American Express, remember our example trading plan, does this trade more than 1 million shares a day? And just before we go to that, if we look at this and we say, okay, this has been uptrending, it's up, $7 today. In an average day, this is average true range. In an average day over the last 14 days, this stock has moved $5.56 a day from the high to the low of the day. So if we say, well, this is at 304, could we, maybe sell the 310, something just above the previous high? And might it in the next 20 to 50 days go above that? Okay. So we have an example of a target. And then where might we put a stop? Well, we might say this recent low here was 296.16. So maybe we'd put a stop maybe 3% below that. And so we could get our calculator out and say if we were to put a stop, 296.16 times 0.97. So 3% below would be at 287.27. And if we wanted to put that on our chart, I'm just going to take this line. I'm going to change this to a stop. And 287.27 so that we can see this on the chart. This would be our stop. So that gives it a fair amount of room to move, doesn't it? And you might say, well, why don't you make it tighter? Well, the tighter the stop, the higher the probability that we could be stopped out. And then if we had our target up here, this is our buy right covered call around 310. It would have to hit a new all-time high, but with the amount this stock moves in an average day, you know, is that a big stretch? And some might say yes and some no. So let's come and look at the trade tab. And the trade tab will give us a lot of information. So if we came out to the January 17th, the monthly expiration, we could be in this trade for up to 38 days. Now, if it doesn't go above 310, or if it doesn't stay above 310, you know, this could expire worthless, or we could buy it back for a fraction of what we're selling it for. But the 310, how much would we receive? $7.10 to $7.35. Does this stock trade more than 1 million shares a day? Check. We're already over 1 million. Do we have 20 times the number of contracts we're thinking of trading? Well, we're going to buy 100 shares and sell one covered call. So yeah, we have more than 20 times that have just been traded today. So we're going to right click anywhere on this line. We want to buy covered stock. So that's the Thinkorswim nomenclature for a buy right covered call. And then if you're saying, well, you know, Barb, what I would like to know is, and I'm going to change this to a calculator, I'd like to know how much I could make. Well, if it's 297.13 is what we're paying to get in, the most we can make is if we get called out at 310. And so we could make 10 plus 280. So the most we could make is 1280. And if you don't want to do the math, you can come here to confirm and send, and it says, okay, the most you can make is 1287. Of course, we're live in the market, so, you know, it was 297.20. It's now at this second 297.13. And again, it's saying how much could we lose if American Express went to zero by January 17th, we could lose almost 30,000, 29,713. You know, but if we look at this, say, let's just call it 1280, just to make the math easy, and we're going to divide that by what we're paying to get in, 297. It would be 297.20. That's a 4.3% potential return for a trade that we might be in for up to 38 days. And so if you're saying, well, hey, I have in this example account, I have almost $600,000 sitting there doing nothing. So maybe I'll take 29,000 of it and do this short-term trade. And maybe you want this because you'd like to take your kids to Disneyland or the grandkids, or you'd like to go to Paris, or like whatever it is, you know, or maybe you just want to grow the account. And then we don't know if we were to buy it back, if this trade went against us, what this call will be worth. We're assuming it would be worth less, but we're going to come up here to first trigger sequence. We're going to right click and create an opposite order. And we're going to say, we don't know what that call would be worth. So we're just going to put in a market order that's good till canceled And if this does not go according to plan and the stop drops below 287, so 287.27, we would like to exit this position. Now, when we look at this, I have a couple of categories here. One is probability of it being in the money. So there's a almost a 41% chance with where the stock is trading now that this could be in the money at expiration. That means we would be called out if at expiration it was even at 310.25. The probability is that we would be called out. We have an 80% chance of it going above 310 between now and expiration. And the further it goes above 310, the higher the probability that we might be called out. So what if, as some announcement comes out tomorrow and this thing bumps up to 320 and we're called out? Are we going to be sad? No, because we have had this conversation with ourselves and said, hey, if this goes up and we're called out, and we end up with a 4 point whatever percent return, what was it? A 4.3% return in under 38 days, in 10 days, we're doing a happy dance. And yes, might we have left some money on the table? Yes, we may have. Now we want to exit if it goes below 287.27. We've sold a call at 310, and this is with the goal of being called out. We're going to put this in our buy right covered call group. And notice it has always, when you read these, which you should, there is no guarantee, that we get out at exactly that price. Okay, we're going to send that in. We're putting it in our buy right group. Now, in another account, we did an example trade on Applied Optoelectronics. And here's our buy right covered call. The intention was to be called out at $40. It went up to $44.50. And then today, it gapped down on the open and then has rallied, but it's still trading lower than it was. It's still down 4% today. And so we entered the trade here, where it's obviously trading lower than it was when we bought it still. But what might have happened to the value of that covered call that we sold? If we're still bullish on AAOI, could we buy this call back and then sell another one when it comes back up, maybe at the same strike? Only maybe, now we're looking at a January expiration. So let's come over to this other account. And we're going to look at our buy right covered calls. And here's Applied Electronics. So we bought the stock for $37.73. It's now trading at $34.62. So we're underwater to the tune of $317. Now, did this call that we sold eradicate the loss? It didn't. But it's taken some of the sting out of it. Now we're only underwater by $80 instead of $315. Oh, when I first looked at this today, it was worth 7 cents. Now it's worth $1. But if we're bullish on this, could we buy this back at $1 and, and then place another trade later? We could. Or could we say, hey, it's trading at $34.50. What's the probability of it going back up above 40? Well, if you come to the trade tab and we look at this December 20th 40 strike, it'll tell you that there's a 20% chance of it being above, but a 43% chance that it could come back and kiss it. Okay. And so, this expires on the 20th next weekend. So if we wanted to do that example of, I'd like to take the profit from that covered call, Oh, was there a downgrade today? So Michelle is saying that AAOI had a downgrade today. And so when you see these big moves, you may want to come over here and see, kind of what's going on. This is news, and you can add this as a gadget. Okay. So we are going to buy this back. And you can see here that we have an exit on this. So we're going to come up, and you might say, well, I want to leave the same stop in place. So we can come over here, click on our wait condition. Our stop was at 28.13. So we're going to remember that. We're going to cancel this order because we want to buy the call back. So we're going to come in here and create a closing order to just buy back the call. So we're going to buy back that call, confirm and send. And then what we may want to do, now we have a position that has no exit on it. And so what we may want to do is come back here to AAOI and create a closing order with a stop. And we'll just put the same stop in place that was there before of 48. Oh, what was our stop? AAOI. Dang it. I thought I had written it down. I've got a great memory, but it's short. So we're going to come to our canceled order. And we just want to look at it. I don't really want to create a duplicate order. I just want to see 28.13. Okay. So we're going to come back here to our monitor tab. We're going to right click, create a closing order with a stop. I'm thinking 23.18. I don't remember. I got to write things down. Okay. So we're going to just put this in as an example and send it in. So now we have a stop loss back in place, and we're leaving this in our buy right covered call bucket because our intention is to go back and do another buy right on this. Okay. Okay. Now, if you wanted to do some additional practice trades, could we look at MasterCard? Do we have a similar type of situation? It too is in the financial sector. It's up 24% year to date. It's been uptrending, bouncing off the 30-day moving average. So could we do something similar with MasterCard? Could we do something similar with Visa? Where it's come, to this 30-day moving average, it gapped up on earnings and then gapped up again. So pretty bullish, up 19% year to date, and it's been kind of consolidating, but bouncing. And if we get called out, we're cool to sell. Was it 28.13? Thanks, guys. I can go in and change that. Okay. And if we're not called out, are we okay to still own the stock? Yeah, and MasterCard is a $500 stock. So obviously, we're not doing this. So how do you exit the American Express trade on the profit side is a question. So let's come back over here. So let's say with American Express, yeah. So we bought this at 707. And we don't have trade price in here. So I really like to kind of customize each window. And for some reason, this one is not. Let me just close all these to get rid of the distractions. So I want to add a couple of categories. So I want to add profit and loss so that we can see, what we're up on the trade. We have a stock position. So how much money have we got invested? I want to add net liquidating value. And I like to kind of have that above the profit and loss percentage. And then I want to add the price that we paid to get into the trade, or the trade price. So we're going to add that as well. And then I kind of like that to be right kind of close to the front. So we paid, $297 to get in. Yeah, I don't know why this says $499.35. But what we've got here on this covered call, so we bought this call, and let's say the most we can make on this is 310. Let's say the net price to exit is now 309. Well, we're up $1,200 on this trade. So we'd have a nice profit, and maybe there's still 2 weeks to go to expiration. So we could come in and either cancel this exit, and then we could cancel this exit and then come in and right click and say, we want to create a closing order to sell this position. Okay, so, or we could wait and end up being called out if it was in the money. But if it's gone through our 310 strike and we've got all of our max gain but a thimbleful, we might just say, hey, why am I risking losing all this gain that I have? It's an unrealized gain. I'd like to realize that gain. So we do that same idea. We would cancel the exit we have in place and go in and create a new closing order. And that's how we would do that. Okay? Okay. So let's go back to our PowerPoint and just review a couple of things now that we've looked at this. So, strike selection, the further out of the money we go, the lower the probability that we will be called out, but the less premium we will get. So there's a balance between the two. And if we are called out, the more we'll make on the sale of the stock, but the lower the premium. So, and the further out the expiration date, the higher the credit will be. So if we come and we look at the trade tab on, say, American Express, which was our example trade, if we said, well, I'd like to be able to do this as a weekly, well, we could look at this 310 strike. We'd only get somewhere between 78 cents and $1. That's not a ton. Where by going out to January, instead of 3 days, 38 days, we were paid $7. Now you might say, well, how about we go somewhere in the middle? How about we go 24 days? Well, the 310, we'd get 460 to 485. And so some might say, well, why wouldn't I do that? Well, you can do that. We have a lot less volume on the options, but we have enough that it still meets our criteria. And you might say, I'd rather do something 24 days out. And then if I'm called out, fine, I could do a wash, rinse, repeat. It's really, but you're looking somewhere often in that 20 to 50 day range. And so there are trade-offs, and this is one of them. Okay. So expiration date, higher credit, but then we're in it for a longer time frame. And some traders will position size based on max loss. Others might base, position size. Well, I'm not going to buy, like somebody said, one of the examples I said you might want to practice on, it was a $500 stock. Well, if you have a small account with only $45,000 in it, that's not a trade you can even place. Or it might be, if it's half your account value, you might say, well, hey, position sizing, I still have to follow a set of rules. So, we have over $1 million in that account. So, a $30,000 position did not, break our position sizing rules. And you may also have a position sizing rule based on max loss. And you might say, well, I'm basing my max loss on the stop loss order. And you know, I know that it could gap down, but that would be a more extraordinary event. You know, often with a stop loss, one might get out somewhere in that neighborhood. So I'm going to base it on the stop loss. And you can, you know, but that's personal. You know, and then how do we exit? Well, you know, like if we've got 50% of our max gain or 80, or I had mentioned 90%, we might just say, hey, you know, we're going to buy this back to close it out. Or we may, hey, if it's only worth 7 cents or 10 cents, or we've got 90% of our max gain, we might buy that back and sell another one a month out, and maybe at a higher expiration. We might say, hey, you know what, this didn't go according to plan, hits our stop, we close out the entire position. Yeah. And, you know, if we hold it to expiration, if it's in the money at expiration, we will likely be called out or assigned, which means we'd end up selling the stock. And we'd have our max gain, but we no longer own the stock. Okay, so this is just a strategy that can be used to generate income. It can reduce the break even of the stock purchase, and this is a way a trader might think of it. I'm not saying that's the way your accountant would think of it. You know, and it's often a short to intermediate term trade that where we can repeat it. You know, I say wash, rinse, repeat. And some investors might plan on getting assigned. Others might not want to be assigned. They're looking, you know, at a way to protect themselves. And you know, we'll talk about that more. There's a class on Mondays taught by Mike Fairborn that just talks about covered calls, buy rights, and short puts. And you know, he'll talk about some of the nuances there. And you know, what are some of the risks? Well, if it goes up like crazy, you know, we've limited our profit potential, and so we have to be cool with that when we place the trade, or this isn't a you know, a good trading strategy. And so we might have to sell the stock if we're assigned. And if that's your plan, you're going, well, that worked out well. But if that wasn't your plan, you know, realize that it's a risk. And the price of the stock can fall, as it did with AAOI, and your downside protection is limited to the premium that you receive. Now, we had a stop in place, but you know, we can still end up in a losing position on these. And the short options can be assigned at any time. And that won't happen in paper money, but in reality, it can. Now, where are we in the proceedings? Well, you know, we started back here just over a month ago with the introduction to options, and these are all in the archives. So you're going to want to subscribe to this channel. You know, this is where we are today. Next week, we're going to talk about short puts, which is an interesting, it's actually a bullish strategy, but it requires a larger account, you know, quite often. But the idea here is that as you go through these, if you have a smaller account, you might say, you know what, this buy right covered call sounds great. My account isn't big enough for me right now to trade this. And so, but you know, these credit spreads look really interesting, and so do these debit spreads. And then we have a class dedicated just to long verticals, and another class dedicated just to short verticals. And so at the end of this 12 weeks, it gives you a better idea of which strategy you may want to focus on first. So I hope I've shed a little light on the buy right covered call strategy for you. There will be a new schedule coming in January. I will be posting links to that on X today. And like I said, come January, Cameron and I are going to be trading places, and he'll be taking this over. Next week, I'll be talking about short puts, and then this will go into the most capable hands of Mr. May. So, yes, it's been a pleasure teaching this class. How do you remove a stop? You can go back and watch this webcast again because I demonstrated that. You just go in and cancel it. Okay? Okay. So, yeah, hit the like button. What that does, if you could do me a favor and hit the like button, what that does is it moves this up in the algorithms on YouTube so more people can find this content. So it's your chance to say thank you to me, thank you to Cameron, and also introduce this to potentially new clients. Subscribe to the channel if you haven't done that already. And then don't forget to follow Mr. May and I in the land of X. Barb Armstrong CS, and Cameron May CS. So thank you so much for joining me today. It's been a pleasure, as always. Up next, trading flag patterns with Mr. Ben Watson. You'll want to stick around for that. Oh, actually, up next, that is what is typically on the menu. Today, we have a very special broadcast called the Market Outlook for 2025. You'll want to tap into that, my friends. So take care. We'll see you in a webcast coming up soon. Bye for now.